Commercial property has been through a lot since the pandemic, from shifting demand to rising replacement costs. So where does that leave investors today, and what's the outlook from here, importantly? So to help us unpack the cycles, the big themes, and of course the options available to investors, including how unlisted funds like the Dexus Wholesale Australian Property Fund fit in, I'm joined by Christopher Davitt from Dexus. Nice to have you here. Thank you so much.
Pleasure to be here.
Just picking up on one of those themes. So, the Australian property market has changed so much since the pandemic, perhaps none more than commercial. So, what has surprised you the most along the way, do you think?
Along the way, I think probably like Cameron said, it's that construction costs have gone up a long way, and that we've got such a mismatch. That's really been unusual, and it sort of sets us up for what the future looks like too.
So replacement costs then, they're top of mind, are they? So how do they shape values and investment decisions right now then?
Yeah, so through the pandemic we had a couple of things happen. We had supply chains disrupted, we had labour costs really go up, a lot of labour shortages. We've had a reaction from interest rates pushing up financing costs, and a lot of builders have gone broke too. All of those things have conspired to mean that the price of bringing new product to stock, and therefore the value of the bricks and mortar that we have gone up. And yet at the same time, those same driving forces of inflation has prompted a reaction from interest rates. And as interest rates have gone up, we've had a resetting of prices down. And what surprised me is this mismatch that's emerged, where replacement costs are a good 30 or 40% above where the market is valuing properties, and that has been a surprise, and it's also got some implications for the future.
What are those implications, if you can just spell it out for us?
Yeah, well, it's as you would appreciate, no one's going to build something for $1 if they think it's only going to be worth 70 or 80 cents on completion. So we've had developers pull back, and the supply pipeline is really coming down across the various sectors. Now, if supply is coming down, and yet we've had pretty substantial demand drivers, as we've had about 1.7 million people come into the country or be born in the country in the last couple of years. We've got, everyone seems to have a job, unemployment rates at about 4.5%, then the tinderbox for a mismatch is starting to build, with demand relatively strong, supply coming back. We think that over the next couple of years, that sets you up for some cream on top of the returns that you'd otherwise expect. A good little period in the cycle. Yeah,
well, you mentioned the sort of various sectors, so to speak, that fall under commercial property. So if we're thinking about industrial, office, retail as well. So
yes.
How does the demand meet the supply in those various sectors? Are they different?
They are different drivers. I think it's most closely correlated in the retail sector. If people come in, they need to go to somewhere to shop, or increasingly to socialise too. That's what these centres do. So that is a sector that's getting the attention of the market after a few lean years, and you're seeing both domestic and international investors really trying to get set into good quality retail in these large growing cities that we have here in Australia.
But overarching it, and you've alluded to it, commercial property moves in a cycle.
Yes.
We've got interest rates coming down, perhaps not next week again, but where in your view do we sit in the cycle?
At the bottom. I think we are at the bottom. If you think about it, and you alluded to it right at the beginning, there's been some big ructions. COVID threw everything up into the air. Then we've had interest rates rise, which has taken the heat out on the pricing side. And I think landlords across the country have been very cautious about keeping their office tenants or their retail tenants, and they haven't really pushed rents, or they've had to reset rents down because there's been a lot to worry about. But we're starting to get to the other side. In fact, we're probably 12 months through the worst of it. And now we're in that phase where we're not just talking about interest rates coming down. They've come down 3 times in Australia, overnight in the US, with hopefully more to come. And it feels like even if we have a very strong period for the next 5 years or so, over the decade you'll have probably only got 7 or 8. So you don't have to hold heroic assumptions about the future to see that as being quite bright.
When you think about bright, do you see the future also brightening for the office sector as well?
Yeah, I think that sort of depends a little bit market by market, and the broad observation is that once again, COVID threw a long shadow, and those markets that went deepest into lockdown are taking the longest to come out of that because patterns of behaviour change, but also I think Melbourne in particular has been impacted by a sluggish economy, high taxes, and a bit of a loss of its mojo in terms of demography, and it was a place that people were flooding into prior to COVID. Whereas markets like Sydney and Brisbane weren't as impacted, and Brisbane in particular has the spectre of the Olympics coming along. Things are getting pretty tight up there because the major contracts haven't yet been awarded, and yet there's already a shortage of construction workers and a pullback on the supply pipeline while the economy is looking pretty good. So I think that office market is it's definitely getting more attention in the last 12 months.
But for investors, our viewers who are interested in
Yes.
commercial real estate, there's been such a focus on industrial,
Yep.
really, over the past, you could say 5-7 years. Do you have a favored sector right now? Is it like picking between your children?
A little bit. But I think I really like for small investors the retail market. Even through COVID, the occupancy was maintained around 98%. You've got a couple of the majors that underpin them. Coles and Woolies are such strong covenants. They draw the crowds. With a good manager, you can mix the centres to match the economy, and switching the tenants around depending on whether people are spending on goods or services has been a big theme that we've been conscious of the last few years. But they have a lot of services in them these days, and services that are good quality businesses run by very smart people with degrees and tertiary, post-tertiary education that mean that you're going to get a good income, and that cash flow is quite reliable. And equally, it's very hard to build new centres, so that's good for capital growth.
I think that the elephant in the room, though, is that direct ownership is not possible for everyone. So how do funds and unlisted vehicles sort of open the door to this market for investors?
Yeah, that's right. I think diversification's a big consideration. Unless you've got $100 million, it's hard to participate. Now, you could go into the REITs. There's some very good REITs, but a lot of people would, that comes with some volatility, and a lot of people would reserve that part of the volatility budget for their equities portfolio, their global equities portfolio, their crypto portfolio. Unlisted funds are appraisal based. In other words, there's a valuation every quarter, and so there's a lot less volatility in the price, and that can mean a more stable part. Now, there's basically 2 ways you can do that in the unlisted market. You go into a syndicate, which is what's called a closed-end vehicle, might run for 5 or 7 years. You put your money in and you hope that you get more money out in 5 or 7 years with a bit of a yield along the way. But they tend to be a bit of a bet on a single property. The open-ended funds have a broader base of properties. They also allow you to come in when you want, and then they'll have less restrictive terms about when you come in, although that varies.
The Dexus Wholesale Australian Property Fund is one of your flagship funds there at Dexus. So maybe you could just walk us through how it's structured.
Yes.
And what type of an investor it might be appropriate for?
Yeah, well, it was started back in 1985, so it's got a very long track record, and it was started for small investors, $10,000 to $10 million. and it's designed to have a big, broad portfolio of good quality properties. We've got 21 properties. They're in office, retail, industrial, bit in the life sciences, bit in the hospitality, bit in the living sector as well. It produces an income yield of about 6%, and it's paid that distribution for the last 40 years without fail. And there's been a little bit of capital growth. So the long-term return has been just under 8%. But it allows you to come in whenever you like, and there's two ways you can request to take your money back. Both of them involve a monthly option on behalf of investors. One where you get your money back around about 12 months later, and the other one, you can get it back sooner, although that's capped. It depends on the level of people wanting their money out of the fund.
So give us an example of a property, if you can, that the wholesale fund is invested in.
Well, this is like choosing the favourites, but I might pick one up on in Brisbane. We've invested a lot into southeast Queensland in the last little while. I won't be hypocritical, so I'll pick a retail property. This is called Gasworks. It's about 2-3 kilometres outside the Brisbane CBD. There's a forest of apartments coming up around it, which is really good for the demand. It's anchored by a Woolworths, which is one of the strongest in the state, and it has a suite of terrific restaurants and other retail shops which take advantage of the sun, but also there's some long-term opportunity to add in some childcare, and I think as a sector we need to remain relevant to what people are spending their money on, which is what makes an asset like that really exciting.
And just to be clear, so you do get distributions as an investor, but you're also looking to those capital returns as well.
That's right. The distributions is cash that goes into your bank account. The capital growth is determined by the valuations, which are run by leading independent valuers once a quarter right across the portfolio.
Okay, but we can't have this conversation without talking about risks,
yes.
Right? Like, what are the risks?
Well, the risks are that the properties go down in value. That's a clear one. I think that's certainly happened at times over the last 5 years. And although we're coming off a much sort of more solid base in terms of once things go down, they tend to go up, it's still a risk. The other risk is around getting your money out. We've got a couple of options around what we do on that front, but neither of them are risk-free. These things should not be regarded as a proxy for cash in the bank.
Yeah, well, we've had a couple of viewer questions ahead of time, thank you, coming from Nina, asking, okay, does the fund invest in REITs?
We are just about to make a small investment in REITs. We have held a larger position over the last few, at times in the past, around about 10%, but that's been terrific for us in gaining access to sectors that we don't hold directly, where we don't have, for example, land lease communities or data centres or self-storage assets in the 21 portfolios. We've used the REIT portfolio to hold those, and it's done really well. Yeah,
interesting, because we didn't talk about data centres. So technically data centres are not, are they considered commercial real estate?
I think that's one of those ones that depends on how they're structured.
Yeah.
They could be put in the infrastructure bucket, they could be put in the real estate bucket. They definitely have a home within real estate, but if the infrastructure guys are claiming them, there's also a validity to that case too.
Yeah, agreed. Okay, and another question coming from Oliver, thank you. This is a good question. What's the minimum investment?
$10,000 if you come into the fund directly,
yeah.
Or if you come in through a platform, that depends on the platform, but really no minimum.
Okay, wonderful. I've got one last question. So if I'm an investor and I'm ready to sort of start investing in commercial property, sort of what's the one play you'd make in commercial property today? You said retail, clearly, but are you still really looking for diversification amongst that commercial subsector? Yeah,
I think the one tip might be to act, because if you're coming in for a long-term return of about 7 or 8%, the market, the portfolio, this fund is in good shape to deliver that with a regular distribution, and you get a 2-3% capital growth coming through the fixed rental increases in the lease. But right now, I do see there being a potential for that gap between investment values to close with replacement cost by values coming up, and you don't know when that window is going to close. So good thing just to get off the fence and jump in.
Well, Chris, it's been wonderful to have you join us. Really appreciate your insights today.
No, it's been terrific. Thank you very much.